Financial markets continue to grapple with complex dynamics in early 2026. Oil prices remain surprisingly steady despite geopolitical tension easing, major crypto companies are reshaping their U.S. strategies, and digital asset investment funds are shedding billions in outflows. Today we break down why this is happening and what it means for global markets and your portfolio. Investor confidence. When oil doesn't spike during geopolitical tension, risk assets stay supported, though volatility remains possible if diplomatic progress falters. According to recent reports, West Texas Intermediate and Brent crude prices have been relatively steady, trading near the mid-60s per barrel, even as tensions involving Middle Eastern energy producers and China's industrial demand dynamics continue to influence expectations. Several key factors are at play. 1. Geopolitical concerns have shifted concerns that might previously have sent crude sharply higher, particularly hostilities in the Middle East, have eased slightly. Renewed diplomatic engagement between certain global powers and Tehran, plus signals that a negotiated resolution on Iran's nuclear activity may avoid broad conflict, have reduced the geopolitical risk premium once built into oil prices. 2. Oversupply expectations. The International Energy Agency has revised demand forecasts lower and projects a supply surplus, even after supply disruptions earlier in the year. U.S. crude inventories rose more than analysts expected, which eases immediate tightening fears. 3. Russia and Venezuela supply. At the same time, Russia has boosted seaborne product exports, and Venezuela's supply situation is stabilized enough that expected shipments are part of trader expectations, all of which mitigate upward price spikes. Effect on markets. Stable oil prices reduces inflationary pressure on energy-dependent sectors. Technical analysis from market data suggests that certain crypto tokens linked to lending platforms are seeing renewed interest as markets anticipate broader regulatory clarity and institutional re-entry. Here's the background. In 2023, Nexo was fined $45 million by U.S. regulators for offering a lending product that the SEC argued should have been registered as a security. As a result, Nexo exited the U.S. market and ceased offering that product to American customers. Now, however, Nexo is returning in partnership with publicly listed crypto firm Bakkt, offering crypto-backed loans and yield-generating products to U.S. investors once again. Cause and effect. Cause: regulatory pressure forced Nexo to restructure its U.S. offering and partner with a compliant firm. Effect: Nexo's return signals a maturing regulatory framework in the U.S. where firms can re-enter the market by aligning products with securities law. Why it matters. Institutional legitimacy. Nexo's return, 3 years after settling with regulators, suggests a path forward for other crypto firms seeking U.S. market access. Consumer opportunity. U.S. investors now gain access to Nexo's lending and yield products, broadening options beyond traditional exchanges. Regulatory signals. The move may indicate that regulators are open to negotiation and compliance-based solutions rather than outright bans. Regulation and product flows. Regulatory clarity, such as Nexo's return, creates nuanced opportunities despite bearish capital flows. According to reports, crypto investment products, including those tied to Bitcoin and Ethereum, recorded significant outflows, flipping 2026 annual flows negative and signaling a broader retreat from speculative assets. For example, Bitcoin-related products saw over $1.3 billion in withdrawals. Ethereum products lost more than $300 million. Other altcoins also logged meaningful outflows. This trend aligns with broader data showing declines in Bitcoin and Ethereum prices through early 2026, with total crypto market capitalization dropping significantly from peaks. Cause and effect overview. Cause: macro uncertainty, hawkish Fed expectations, post-Warsh nomination, geopolitical volatility, and liquidity tightening triggered a risk-off sentiment among investors. Effect: digital asset funds experienced withdrawals as investors rotated out of high beta assets into safer or more liquid instruments. In addition to fund outflows, heavy leverage positions have been unwound, driving volatility and downward price pressure across digital markets. In early 2026, markets are shaped not just by headlines but by structural pressures, from geopolitical risk easing oil volatility to regulatory shifts bringing crypto products back to the world's largest financial market, to investors pulling capital from digital asset funds in the face of macro uncertainty. These three threads, oil, crypto regulation, and investment fund flows, illustrate the complex interplay between policy, sentiment, and market dynamics. Understanding them together gives you a clearer view of where markets may head next. If you found this breakdown useful, hit subscribe for more clear, data-driven market analysis, and drop a comment on which trend you want us to explore next.